Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook and your host for the next 25 minutes here on Options Guide TV. Well, we had another successful earnings trade. Considering that you have to get the direction right, well, I guess it hasn't been that rough in this earnings season, in that 83% of the companies that have announced earnings have beat analyst estimates. So hence we have all-time highs. It's not necessarily because of what's going on in the economy and the geopolitical concerns that we have going on just across the world, let alone in the Middle East. And also what's going on with inflation. CPI numbers were not too rough on the market. Market was anticipating a little bit worse. But basically, by looking at where the market was on Tuesday before the open, and then the number came out, and the market actually rallied into that number and had a medium day as far as the market was concerned. So fairly decent, but inflation is going the wrong direction. People are not comfortable with it. It is an issue. Jobs can be an issue. Who knows what's happening with AI? So right now, I think overall the economy is about running at a C level, where we see the marketplace running at a level. So today we're going to actually short a stock. We're going to short a stock that has a great run up, that is in the AI space. As a matter of fact, the company has beaten the last 15 quarters in a row, and valuations are high. So because of that, I'm going to actually get short. We got a run up today heading into their earnings. The company is known as Cisco. Symbol is CSCO. So they're announcing after earnings. But before we get to the Cisco trade, let's look at the NXT long butterfly that we have on. I was able to execute it in my account for $1 net credit. Right now, we actually see that position when we went to put it on. We were looking at $1.30 net credit. Now, I'm very curious if there's anybody out there that actually executed somewhere close to that. I was surprised because we actually looked at the short call spread, that the call spread that actually pays for the butterfly. And we just the numbers didn't seem to add up, but I was able to execute it for $1. I didn't get the $1.30, and I did it after the show, after we were done. So, so the market had moved. Let's just put it that way. But I was really surprised that I was able to get it done for a net credit of $1. Right now, you could get out of the position and take off that and get 50 cents on the trade if you wanted to do that, and that's fine, but I don't see a reason to do it in NXT, which is Next Power Incorporated. Good earnings. Obviously, the market accepted it that way, but the stock didn't make that massive one standard deviation move, or even the expected move to the upside. So here's NXT. Let's look at the chart in NXT. Our position was we needed it. Well, we didn't want it to go beyond 170. And we saw a strong move up. And right now it's up 15. It's trading at 141.08. We got up as high as 156. So, I mean, I'm trying to say, I think this is the best outcome you could have if you were going to pick an outcome, because we did go out a little further in time on our trade that we talked about on the show. We looked at a short-term trade, and we also looked at the longer-term butterfly. Longer-term butterfly skip strike was more interesting to me because the net credit was good. $1.30 on $5 of risk going way out of the money. I mean, I really liked that on a stock that has, basically been rewarded. I hate to say rewarded and attribute that to a conflict, but in the Middle East. But it's done well since the conflict has started, and because of that, the stock has now actually kind of hit its high, started to chop a little bit, and heading into earnings, we actually saw a breakout to the upside. So the earnings was enough power to break it out to the upside, but we've already had to move on the stock. And if anything, I think the path of least resistance is to the downside. Strong earnings report, though. So with that said, it going up 14 points when our target is 170 going out to June 18th, it means that we can hang around. We've made it. I made about 50 cents on the trade right now. If I bought it back at 50 cents, I would make 50 cents because I got it done for a net credit. If you got it done for $1.30, you could take it off right now and make 80 cents on the trade, which is totally fine for the risk reward profile that was out there. But we have our hedge on, so there's not any rush to do this. We do need some more time decay to happen. And if the stock did run up to 170 again tomorrow, we're going to be negative delta on the way up until we get closer to that expiration date on June 18th. So let's grab this trade. Let's send it to the what if calculator. And instead of me just talking about it, I'll try to show it a little better. And I'm going to check these boxes just to make it simple. But here's the what if calculator. Stock is here, 141. 130 was the net credit. Right now, it actually is saying we pulled it in at 97. It actually is saying the credit was 97. Now, you're flipping this upside down because this is the position we have on. But to close it, it would be sell to close, buy to close, sell to close, as opposed to buy to open, sell to open, buy to open, right? But this is what the graph looks like as of today. Comes up here, goes all the way up to this level, right at the 170 level. And then your risk kicks in from what the strike that we would skip on a standard butterfly, which is 175, and continues on up. Now, if when we came in here, it was a $97.50 net credit. It's 73 cents. I don't mind putting this trade on right now. I like the trade. I could actually see doubling up. We had the market move 14 points, right? So there's a rationale as to why it could still be trading for the credit that I received in my account. You had the vol come in, the implied volatility came down, but the market went up. So positive delta, the delta, it helped the position. In our instance, if the market would have went down, we could have got more of the credit that we received. But I like it being right here because now if you don't have that catalyst, you still have the conflict in the Middle East going on. So those news headlines, I think, will dominate anything way more than the actual earnings report, actually. But with that said, you're still getting a lot of vol. And because of that, you can get this done for, gosh, it's saying 97-cent net credit. I think we're going to double down. We're going to do it. If we can get this done for 92 cents, I'm going to make this the official paper trade. So let's go. We have it here. We're going to send that to the ticket. It is all over the place. Oh, now it's 72. If I'm going to leave it in there at 90 cents. If we can get this done for a net credit of 90 cents, and it's at 92 now. All right, let's run over to the order ticket. NXT. And I can't really scroll up on it, but we'll try. We'll try as much as we can to get it up there. All right, so we're at the very high of the range, so there's not many strike prices that are left. All right, so here's going to be the trade. This is going to be the official paper trade. I'm going to double down on the trade. NXT, Next Power Incorporated, trading at $140.75. It's up $15.38 after its earnings. The implied volatility has came off quite a bit. It was way up in the 150 level. Now it's all the way down to the 77 level. But it's still very high implied volatility for the June 18th expiration, which is 36 days out. We're going to look with the stock trading right around 140. We're going to buy the 165 strike call. We're going to buy one of those. We're going to sell 2 of the 170 strike calls, and then we're going to skip over the 175. That would make it a standard butterfly, and we're going to buy the 180 strike call. That means that we're embedding a short spread into our butterfly, which will pay for our butterfly. Midpoint price when we came into the options grid was a net credit of 90 cents. I want to get that net credit of 90 cents. I don't want to do this trade. Midpoint right now is at 78 cents, but I'm going to let this trade work itself and see if we can get filled at a net credit of 90 cents per 1x2x1 butterfly. We have 5 points of risk minus the 90-cent net credit. That means the maximum we could lose on this trade is $4.10. But we have our buffer in, we have our hedge, we have our long spread that goes from 165 to 170. So if it closes close to 170, we can put this on for a net credit of 90 cents. Yes, I said a net credit of 90 cents, and sell it for as much of a net credit as $5. That means $5.90 is the maximum if it went out right at 170, right at expiration. But this is a neat trade in that you can put it on for a net credit, and then if you're correct on your forecast and it lands somewhere close to the center strike of your skip strike butterfly, you can also sell it for a credit. I should say close it for a credit would be the right vernacular to use. All right, so we're going to send this down to the trading floor. Boom goes the dynamite, and the order has been sent. All right. I like it. So that was a bonus trade to go along with the other trade that we did today. Or let's add on to that trade. Let's look at Cisco. And I was going to start with the chart, but I got kind of excited when I saw that, man, look at that trade. Now it's trading at $1 net credit to the account. Midpoint credit. Yeah. This should fill somewhere close to that. I think that 90-cent net credit should get filled. It might be getting filled right now if you haven't entered into your brokerage account. Now, if you have any comments, got any questions, please do put them in the chat box. Happy to address them. We'll throw them up on the screen and we'll talk about them. So this is a live interactive show. And to go along with that, I want to mention the Fundamental Friday shows. We've changed Fridays into a day where we're going to learn about options, the basics of options, and we're going to do it real time with real markets, with real stock. And we're going to already put a 4-part series together on the basics of options, and you will receive that if you actually go to the description below and you open up an account with Tradier. You'll get access to the paper trading account, and you will be able to trade right along with me on Tradier.com and learn about option trading and how we're going to start out by how it's enhanced, how it can be used to enhance a stock portfolio. And then we'll get into the more deeper option trades where we're just trading options and there's no stock that's involved whatsoever. I digress. So let's look at Cisco. And like I said, 15 quarters in a row of beating earnings, all about AI data centers. We're trading at 100 right now, and it's up $1.42 on the day. Look at the strong candles. I guess we did we paused for a second, right? We had one little pause yesterday, but 1, 2, 3, 2 really strong days, 3 up days where we closed at the highs, came down, closed at a low, and now we're back up again. Earning announcement are after the close tonight. Want to confirm that. I always scare myself. Yep, it's saying after the close on Wednesday, May 13th. There we go. Yep, should be good. Should be good today. Earnings date May 13th. So after the close today, let's go and let's get bearish on Cisco. Dare I say that? Dare I say that? I want to get bearish on Cisco. We've had about 5 earnings trades in a row that have been doing well right after the earnings. This was the strong breakout at 88. Very strong breakout here. came back, retest, and then bounce. So like if you're going to talk about breakouts, you have all your ducks in a row. You have your 200-day, 50-day, 20-day. It breaks out and then comes back and tests and then takes off. That is a classic breakout pattern. Once it broke here and you had this white candle, that was a very bullish signal in Cisco, and it did reward you if you got on it. We didn't talk about it on this show. I'm just looking at the chart and making an observation. So let's fade it because it's been too strong. They're going to have a real strong earnings quarter again, even though they've done it 15 times in a row. I think of this as an opportunity to fade the market a little bit. So we're going to do a fairly aggressive. Yeah, let's do 2 days. Let's go. Let's make this is going to be an all or nothing trade. This isn't any. This is a very speculative trade on Cisco. Remember, not meant to be a recommendation. We're going to go fairly wide, give ourselves a bit of upside if we're correct on our, I guess, outlook that the underlying market would go down after the earnings report. Okay, 2 days. If we start by looking at the money straddle, we're talking about 8 points. So about 8% because it's a $100 stock. The math is easy. 92 is about where that's at, and that should be a delta close to 20, and it is. And that's usually where the expected move hangs out, right about at the 20 delta. That means that if we bought the call and we bought the put, I always like to explain it as the over-under, right? What's the potential move by the first earnings or first expiration, which is May 15th, 2 days away. And the marketplace is saying that that is about an 8-point move to the 92 level. So let's go. I like the 98s. We're going to start here. Let's buy. And that's 4 points. I want to give myself, let's go to the 90. Let's look at the 90 level. We're going to sell 2. So that would be 8 points wide. And then we're going to stop short about 4 points. So we'll go down to 86. Yeah, and that's trending for 25. I like that. Very cheap. Fortunately, buy, sell 2 of the 90s. That's right at a 1 standard deviation move, about a 13% chance. Yeah, let's get a little bit more premium. Let's sell the 91s. That's a 16. That's right at a 1 standard deviation move right now. I'm going to get rid of one of those, and okay, now I'm going to add one back. Why don't I? All right, buy 1, sell 2. Now this is an open wing. This is the evil stepchild to the skip strike butterfly. It's an alternative to a standard. And I like to think of it as an alternative to a long put spread, as opposed to think of it in terms of butterflies. So now we got 7 points. We'll go down 3 points. 88, 39 cents, 87 would be 4 points. Yeah, I'm going to go 88. And we're going to buy. 1 by 2 by 1. Let's send this to the what if calculator. 161. Yeah, I like this trade. I like this trade. Where are vols at? 135. Bang. And IV is around, or historical is around 50. So that really needs to come off. 161. So be prepared. Cisco announces earnings and the market perceives it, that doesn't sell off because they had a good report, right? But a lot of disgruntled people about data centers. So it will be interesting to kind of hear their comments afterwards. And people are just looking into are interesting to see if that news kind of carries over and people take this opportunity to sell the stock off. That's my thesis, at least. 161, $161 per 1x2x1 open wing butterfly. Maximum upside would be that it could trade for as much as $7 minus that 161. If it goes beyond the 188, you have 7 minus 3. It could trade for 4 beyond that level. Let's look at the what if calculator. And our maximum upside up there, it did take 161, so that's nice. We would be up $100. No, we should be up more than 100, right? 161. Oh yeah, over here. That's the maximum that we're okay. So 161 is what we pay. That's right. 161. So this is the loss. So we're going to the downside. We're being bearish. We'd be up more. We're going to make at expiration, we can make $238.50 anywhere below 88. So maximum right up here, and we're looking at these numbers. If at expiration went out right at our strike of 91, we're looking at $537 approximately. It continues on down below 88, and we're looking at $238 approximately. Max risk is 181 or 161. Anywhere between 98 and 91, we're good. Our break-even point is we need to get it to 198 minus the 160 or 161. So we're looking at about, what is that, about 97.40, 95.40? 95.40 should be about where we cross that break-even excess. Where's the break-even line? Oh, right here. 96. I'm sorry. I apologize. 96.40. $1 off. 96.40 is where we cross that break-even line. All right. Any questions? Any concerns? Let's see if we can do another one. It will be a good earnings session for Options Guide TV if we can get. And this one I believe is the most speculative. I really like the NXT trade after the event. The implied volatility is really interesting. To be able to do a short spread like that, make 20% on the width of the spread, still have some potential for some upside going out to the June 18th expiration. I think I could do a rinse and repeat on that again if the market actually went down, coming back. If as long as that vol stays high, I like that trade in NXT. All right, that's it for this edition of Options Guide TV. We'll see you on Friday, for Fundamental Friday, 11 a.m. Eastern time. And we'll come back on Monday and we'll look at the Cisco trade after the earnings and we'll review the NXT trade. I'll make sure that these positions get put inside the paper trading portfolio. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.